Hello, dividend growth stock investors. Colby the DGI Crab here, wishing you happy Sunday. And today is the day that I go over the 4 tiers. That's right. This channel focuses on 60 individual dividend growth stocks split into 4 separate categories or tiers based on the age and time horizon of the investor, which I believe is the most important metric for any dividend growth stock investor to take into consideration when adding that passive income. I've got a little pep in my step yet again this week as Pepsi is still down. It is one of my top 10 favorite dividend growth stocks, and I am happy to get the chance to add to it while it is showing some major signs of undervaluation. Don't have as many stocks this week in that coveted buy zone. Definitely have a few of the usual suspects still, but consistency is the name of the game. And you got to be excited when you're buying your dividend growth stocks. And the time I'm excited to buy them is when they are trading down. Now, I'm not a professional financial advisor. The content of the channel should be considered primarily for entertainment. The opinions expressed regarding investments are my own, and you should always perform your own due diligence prior to investing your hard-earned money. So for those of you who are new to the channel, I will just quickly cover my personal allocation strategy. I put 50% of all new money each week into age-appropriate ETFs for automatic diversification, and I'm targeting stocks that are yielding 30% or more above their 4-year average yield. I will grab any of my top 10 favorite dividend stocks if they're yielding 20% or more above their 4-year average yield. Pepsi just happens to be one of those. Now I remain within my specific age tier unless there's a stock in a different tier that's yielding 50% or more above the 4-year average yield. I will jump on a bargain even if it's not as quote-unquote age appropriate as it might be. And if there's not a buyable stock within my personal tier, I will simply add more money that week to the ETFs. So, as we hop over into the spreadsheet and take a look at our stocks here, we're going to start with our Tier 1 category. These are the stock for the 18 to 30-year-old investors, where we're looking for probably admittedly low starting yield, anywhere from like 1%, maybe 2%. But what we want to get is a 10% or better dividend growth out of the entire group, because we want to have a lot of dividend growth for these young investors to be able to snowball that income as they've got a lot of years in the market to take advantage of those big raises. We're sorting here by the valuation tab, which is where I am taking the 4-year average yield, which I update every single weekend, so we have the most up-to-date number here, and comparing it to the current day yield to see how far off it is. If we've got stuff in the green, it's hit my 30% or more undervalued mark. Anything in the yellow, 20 to 29%, and anything in the red is less than 20% undervalued. So any of this stuff that's in the red, I don't sell it. I'm a long-term buy and hold dividend growth stock investor. I have my dividend reinvestments turned on across the board so I can continue to grow my positions in things like Centos or Broadcom or Parker Hannifin with my dividend reinvestment, so that way I'm not constantly thinking about trying to time the market with the individual purchases. I'll try to time the market with the new money I'm adding in, but not so much with the dividend reinvestment. So United Health, Nike, these have been the 2 biggest dogs among all 60 of the stocks on my list here. They are yielding more than twice what their 4-year average yield is. And, you just have to understand that both of these companies have had different reasons for being negative headline producers. A lot of drama around UNH, a lot of projected sales numbers getting pulled back by Nike. Both of these companies appear to have plenty of free cash flow to be able to continue to comfortably continue paying out that dividend, and will hopefully continue to provide us with dividend raises year over year. I'm confident that both of these companies will be able to do just that. United Health is still the largest player in the insurance market, and Nike is the largest shoe manufacturer on the planet. So I think that they're going to come through this just fine, but man, they have had a rough stretch here for a little while now. But these young investors can grab yield comfortably above 2.5% on both of these, which is pretty high considering the average that they might be going after. And then Nordson, dividend king with decade upon decade of consecutive annual dividend increases, had fallen all the way down into like the $180 range. They have recovered all the way back up to just shy of $212 a share. That is good to see. Still look underpriced to me, even at that price. So I think it's one to continue to add on. And then, as I covered yesterday, we got a really wimpy dividend increase again from Lowe's this year, which was kind of a bummer. That did increase their current day yield by a bit, but not enough to put it into the buy zone. Tier 2, age 31 to 41-year-old investor. We're getting a little bit higher starting yield here, 2 to 3.5% typically. And what we want is high single-digit annual dividend increases year over year. We've got 4 in the category this week. McCormick was in that category last week, but they recovered in price just a little bit. So once again, hitting the pause button just very briefly on McCormick. And I'll be focusing more on the top 4 here. Target, I think I talked about this a little bit with you guys last week. As they start putting more and more time and money into their online shopping experience and their distribution centers and things of that nature, it does make me worry a little bit that maybe their dividend increases are going to continue to be very small year over year. This is what happened to Walmart back in the 2010s, and where Walmart used to do great dividend increases year over year over year. And then for like 10 years now, they've been doing very small dividend increases. We got like a 9% increase out of Walmart last year, and that was the largest dividend increase they have produced in more than a decade. And as great of a stock and a company as Walmart is, those really small dividend increases compared and in contrast with their already really slow starting yield just didn't allow them to make the cut for me as a dividend growth stock investor. Target, you can buy it right now yielding 4.77%, which seems like an absolute steal to me. Even if the dividend increases are small for a little while, it's a really nice high starting yield to add on to, and I think this dividend king is going to be just fine. They can cover that dividend. So unless management wants to just totally scrap the whole status of being a dividend king and go full bore into the tech space, then I think this dividend is going to be very safe as far as cash flow goes, but you never know. I mean, Walmart's a dividend king as well. They elected not to cut theirs. I'm hoping Target doesn't either, but I don't remember Walmart's yield ever getting up this high, so we'll have to keep an eye on that. Hershey, still another one of my favorite ones here, yielding 3.41% with a 4-year average yield of 2.17. Definitely have a great opportunity to keep adding Hershey at a much higher than average yield. Starbucks and NextEra Energy are also right there in the buy zone. Fine purchase points for either one of these. If these are companies that you are comfortable buying, let me know what you think about these, you guys. Tier 3, age 42 to 53-year-old investors. The starting yield continues to get a little bit higher in this category. The overall annual dividend growth rate starts to get a little bit slower here. This is a category full of dividend kings and aristocrats that have been doing this for such a long time. Archer Daniels Midland remains at that number 1 most undervalued position. They have been here for quite a while now. It just absolutely shocks me they've been yielding above 4% for as long as they have. Their 4-year average dividend yield does continue to gradually creep up, but I still think that this is a fine purchase with a yield above 4%. Pepsi, as I said, this is my favorite value among all 60 of the stocks on this channel right now. It is in my top 10 favorite dividend growth stocks. In that 50% or more undervalued category, I think this is a great purchase no matter how old you are. Pepsi at 4.33%. Very excited about this one. Hormel, you know what, guys? The longer Hormel hangs around between $29 and $31 a share, and the more that 4-year average yield continues to creep up, the less Hormel looks like a good buying opportunity, because the higher 3% starting yield is starting to look more like the norm than an aberration. So eventually, if this 4-year average yield continues to creep up and Hormel continues to flatline, then it's going to fall out of the buy zone. But for right now, I'm still got faith in Hormel. that they are going to continue to raise their dividends. Maybe not as fast as they've done in previous years, but I think they'll work their way out of this. Genuine Parts Company, Chevron, T. Rowe Price, all close but not quite, although I do think Chevron is a pretty nice buy at 5% yield or better. Tier 4, age 54 and older investors, where we want higher starting yield, 5% plus starting yield. Still want some dividend growth, but it's probably going to be in the 2 to 4% range with this group of 10 stocks here. The high yielders continue to get a lot of love, you guys. There's just not much undervaluation here to take into consideration. So tier 4 investors probably should continue to focus on adding higher yielding ETFs as opposed to single stocks for the current moment. Now, if we head over into the strategy tab, this is how I would be breaking down my dividend investment for the week. This is a percentage of income. So as I said at the top, 50% into ETFs at a minimum each week. If I'm in tier 1, I would be doing 25% into the S&P 500, 15% into a small cap, 5% into VIG for dividend appreciation, 5% VYMI for international investments. Tier 2, same 4, different weighting where 25% goes to dividend appreciation, 15 S&P 500, 5 small cap. Tier 3, SCHD, VYM, DHS at 25, 15, and 5 respectively. Still really like all three of these ETFs for different reasons. And I think that you could certainly just drill down on one if you wanted to simplify it. But I like to kind of spread my money around a little bit, even amongst the ETFs. So I've just got varied sources of income coming into the portfolio. And then for tier 4, definitely a little bit more complicated in tier 4. We're getting 15% into SPYD for the stock exposure, and then 5% down for high yield bonds, preferred shares, MLPs, Devo, JEPQ, and SPY-I for covered call ETFs. I have a separate video regarding ETF investing for the age 54 and older investors. Go check that one out on the ETF playlist for my reasoning for why I picked each of these ETFs. For the tier 4 folks, since there aren't any stocks in their category that look to be drastically undervalued, I would consider, once again, the ETF double down and just go 30 and 10 all the way down. With the exception of VYMI, I keep that international at 5%. So if this represents 95% of my investment dollars, if I'm in tier 4, I'm going to throw 5% into Pepsi, and that'll cover me on tier 4. And for the rest of the crowd here, if I'm in tier 1, I'm going to first look at the stocks in my own tier. So I'm going to be looking at Nike and UNH, maybe doing 10% each into those, and a 5 into Nordson. I am going to hit Pepsi at 10% because I want to build up a position in the top 10 favorite stock. And then Target, Hershey, and Archer Daniels Midland, all at that 50% or more undervalued in the other tiers. You can reach up and grab some higher yielding stuff while it's underpriced, because if you're holding these for decades to come, you ought to be in a position where you're going to get good share price appreciation on these if you're buying them while they're down in the dumps. At least that would be the theory that I would go with. Tier 2, I'm going to start at my tier 2, Target, Hershey, Starbucks, and Next Era Energy are going to be where I begin my focus. Then I'd prioritize adding some Pepsi. And then with whatever I've got left over, I'd be going United Health, Nike, Archer Daniels Midland. And then for tier 3, Pepsi's my priority. Archer Daniels Midland and Hormel would be next up to cover the ones in my own tier. And then I can go down tiers here and grab Target, Hershey, UNH, Nike, because really all of these are yielding high enough. Even, Nike and UNH in the tier 1, those are yielding high enough for me to want to grab those as a tier 3 investor. Mostly I want to be getting stuff in the 3 to 4% range, but I'll continue to add to the stuff that I think is going to give me really nice dividend growth in the long term as well. And I think that's what these are going to do. So that's the breakdown for the week, you guys. Let me know down there in the comments what you are buying, and let me know if you own any of these stocks, if you're grabbing a hold of any of these. Let me know if you have anything that you would like me to cover, either in the comments section down there, or send me an email, dgicrab@yahoo.com. Don't forget to like and subscribe. Tell your friends about the channel, and I hope that this has been helpful for you. Keep investing, everyone, and I'll keep in touch this week.